The economy should already be in a recession. Prices are rising, jobs are quietly disappearing, and debt is exploding. And yet, the stock market keeps climbing like nothing is wrong. If you feel like something doesn't add up, you're not crazy. This exact setup has happened before every major crash in history. Right now, three powerful forces are building pressure beneath the surface, and when they collide, it won't just be a market drop. It will be a massive transfer of wealth. The real question is simple. Will you panic or will you prepare? Look around you. Groceries cost more. Rent costs more. Fuel costs more. Everything costs more. Your salary hasn't doubled, but your expenses have. Households are spending thousands more every year just to maintain the same lifestyle. But while your wallet feels lighter, the stock market is near record highs. Tech stocks are flying. Investors are celebrating artificial intelligence like it will solve every economic problem. This disconnect is not random. It's phase one of every major crash, the illusion phase. The first force building right now is debt pressure. Household debt is at record levels. Credit cards, car loans, personal loans, all rising fast. The problem is that much of this debt was taken when interest rates were near zero. Today, rates are much higher. That means servicing that same debt is now far more expensive. Businesses are facing the same squeeze. During the pandemic, companies borrowed aggressively because money was cheap. Now refinancing costs much more. When debt becomes heavy, companies cut costs. Layoffs begin. Hiring slows. Spending drops. And when spending drops, the economy slows with it. We're already seeing stress in commercial real estate, with empty office buildings and rising loan defaults. When banks start taking losses, they reduce lending. And when lending slows, the entire system tightens. The second force is the Federal Reserve timing trap. Most people believe rate cuts are good news. Historically, that's not true. Recessions often begin after the Fed starts cutting rates. The Fed doesn't cut because everything is strong. They cut because something is breaking. In past cycles, rate cuts came months before markets fully collapsed. There is always a delay between policy changes and economic pain. Right now, rates stayed high longer than most expected. Consumers are stretched, savings are lower, corporate balance sheets are tighter. If aggressive rate cuts begin, that may not signal recovery. It may signal stress. The third force is valuation risk. There is a metric called market cap to GDP, which compares the total stock market value to the size of the economy. Historically, around 100% has indicated fair valuation. Today, that ratio is at extreme levels. Markets are priced for perfection, but the economy is not perfect. Growth is slowing. Debt is high. Pressure is building. When extreme valuations meet economic stress, markets correct. We are currently in phase one, the illusion. Markets are high, confidence remains strong, and most people believe everything is fine. Phase two is recognition. That's when a major shock appears. Maybe unemployment rises faster than expected. Maybe a large institution reports losses. Maybe policy shifts accelerate. Investors begin to realize something is wrong. Phase 3 is panic. Markets fall sharply, fear spreads. And this is where wealth transfers, not destroyed, transferred, from emotional investors to prepared investors. So how do you use a potential 2026 market crash to get rich? Not by predicting the exact day, by preparing before it happens. Build a cash position, not all cash, but enough so that when others are forced to sell, you can buy. Create a watch list of strong companies with low debt, real profits, and long-term relevance. When panic hits, even great businesses get discounted. And most importantly, train your psychology now. When markets drop, your instincts will tell you to sell. The investors who build wealth during crashes are the ones who act strategically instead of emotionally. Every major crash in history created massive opportunity for those who were ready. The crash itself doesn't make you rich. Preparation does. If volatility hits in 2026, you will face two choices: react emotionally like the crowd, or act strategically while others panic. The next wealth transfer may already be building. The only question is whether you'll be ready for it. If you found this valuable, make sure you subscribe, because when the next phase begins, we'll break it down step by step. And remember, this is education, not financial advice. Start preparing today. Your future self will thank you.